In the last 3 years, something has been happening quietly in the background of the global financial system, something so large, so deliberate, and so historically unprecedented that it should have been front-page news every single week. Central banks, not retail traders, not hedge funds, not gold bugs, have bought over 3,000 tons of gold. That is the fastest, largest accumulation since 1950, when the world was still rebuilding from a world war. This isn't normal diversification. This isn't portfolio balancing. This is preparation. And if you're watching this from your apartment, your kitchen table, or your lunch break at work, here's the part that hits your life directly. Central banks never move first unless something big is coming. They act early, so the public can act late. They act quietly, so the public reacts loudly. They act strategically, so the public acts emotionally. And right now, they're not just buying gold. They're racing to get it. China, Russia, India, Poland, Turkey, Singapore, dozens of nations, all in different time zones, under different political systems, with different ideologies, are suddenly doing the exact same thing at the exact same time. They're dumping U.S. treasuries. They're reducing dollar exposure. They're hoarding physical metal like the global monetary system is about to flip upside down. And maybe it is, because every middle-class American can feel it even without charts or economic reports. Your rent feels heavier. Your groceries feel steeper. Your paycheck feels thinner. Your savings feel weaker. Your 401k swings like it's drunk. And every time you check your bank account, it feels like the numbers are lying to you. You're not imagining it. Something is breaking, and the people in charge can see the cracks long before you do. Here's the part nobody in Washington wants to say out loud. When a country reaches a certain stage of debt, a certain stage of currency strain, and a certain stage of geopolitical backlash, collapse doesn't arrive like an earthquake. It arrives like a slow leak, quiet, gradual, invisible until the pressure is gone, and then everything drops at once. History has a name for this moment. It's called the gold revaluation debt erasure cycle. It's one of the oldest tricks in the empire playbook. When debts become unpayable, when promises become impossible, when the mathematics stop working, governments turn to the same silent solution. They destroy the value of the currency and reset the system using gold. It happened in Rome when emperors debased the denarius. It happened in Spain when silver flooded the empire and collapsed its purchasing power. It happened in Britain during the slow death of the pound's reserve status. And it happened in the United States in 1933, when Franklin Roosevelt changed the price of gold with one pen stroke and quietly erased 40% of America's debt burden overnight. Every time, the pattern is the same. Every time, citizens lose purchasing power. Every time, elites move into hard assets first. And every time, the middle class gets caught holding the bag. Which brings us back to the question no economist on cable news can seem to answer. Why are central banks buying gold at a pace we haven't seen in 73 years? They're not buying because gold is fashionable. They're not buying because gold is shiny. They're buying because they know what happens next. They're following the pattern. Let me show you how the first phase always begins. First, institutions with intelligence access real intelligence, not the sanitized public version. Identify the tipping point. They see capital outflows before the public sees headlines. They see geopolitical fractures before the public sees tensions. They see reserve shifts before the public sees inflation. Then they quietly reposition. They reduce exposure to the failing system. They increase exposure to the replacement system. They accumulate the one asset that survives every collapse: gold. And while all of this is happening, regular people, the ones working 2 jobs to survive, the ones budgeting groceries, the ones paying rent that jumps every year, are told everything is fine. Inflation is cooling. The economy is resilient. The system is stable. But behind the curtain, central banks are operating like the dollar's best days are behind it and a monumental reset is ahead. And here's the paradox that should freeze you for a second. The same institutions insisting the dollar is strong are the ones buying the asset you buy only when the dollar is weak. That contradiction is not an accident. It's the first clue. The second clue is the scale. In 2022, 1,036 tons. In 2023, 1,037 tons. In 2024, on track for another 1,000 plus tons. These aren't tiny adjustments. These are fire alarm numbers. Numbers that signal something irreversible is approaching. Something central banks are preparing for. Something they're positioning around. Something they're not going to warn the public about until it's already happening. Because when the cycle completes, when the reset hits, there are only two types of people. Those positioned early with hard assets, and those positioned late with collapsing currency. You already know which group central banks belong to. But the part that matters, the part that changes everything for you, is what comes next. Because in every historical cycle, the turning point is the same. The public always learns the truth too late. This time, you won't. Because the next section will reveal the full pattern the United States is walking into right now, the same sequence of events every collapsing empire followed, from Rome to Spain to 1930s America to the modern petrodollar. And once you see that pattern clearly, you'll understand exactly why 3,000 tons of gold just disappeared into central bank vaults, and what that means for your savings, your retirement, and your financial future over the next 18-36 months. Every empire that reached the point where it now followed the same sequence, almost like a script written centuries in advance. Different leaders, different cultures, different flags, same math, same pressure, same ending. And when you recognize that pattern, you stop seeing the news as random events and start seeing it as a countdown. The first stage is always denial. The numbers look dangerous, but the officials insist everything is fine. Debt rises, but policymakers say it's manageable. Currencies weaken, but they call it temporary. Inflation spreads, but they blame supply chains, weather, geopolitics, anything except the system itself. This is the stage we've been living in for years. The second stage is quiet repositioning, not by the public, not by small investors, by the entities that matter. Central banks, sovereign funds, the institutions plugged directly into geopolitical intelligence. They start making moves that contradict their public statements. They say the dollar is stable, and then reduce their dollar exposure. They say gold is outdated, and then buy more gold in 12 months than they bought in the previous decade. We are deep in this stage right now. The third stage is the structural break. It's never a crash at first. It's an announcement, a deal, a sanction, a freeze, a shift in trade settlement that seems symbolic on the surface, but starts a chain reaction. When the U.S. froze $300 billion of Russia's reserves, it was framed as a punishment. But for the rest of the world, it was a warning. If they can freeze Russia's money, they can freeze ours. That moment fractured 50 years of trust in the dollar, trust built through wars, treaties, oil deals, and global trade. And once trust breaks, reserve currencies bleed power long before the public realizes anything has changed. The fourth stage is when alternatives rise. Not suddenly, not loudly, but persistently. Countries begin settling trades in their own currencies. Regional blocs build payment systems that bypass the dollar. New alliances form BRICS, ASEAN, Eurasian frameworks designed to dull America's financial reach. This is where the petrodollar, America's secret power source since 1974, starts to flicker. When Saudi Arabia sells oil to China in yuan, even once, the world takes note. When Russia and India settle energy in rupees, the world takes another step away. When Brazil and China trade in yuan, when ASEAN talks about bypassing SWIFT, when African and Middle Eastern nations show up at BRICS summits, the center of gravity shifts, and the dollar loses altitude. The fifth stage is the point of no return, a debt load so large that no tax plan, no economic boom, no political promise can fix it. That's where the United States stands in 2025. $37 trillion in debt, trillion-dollar annual deficits, interest payments that now rival military spending, more debt being added every 90 days than we added in entire decades. It's the stage where math wins and governments lose. And when governments lose to math, they turn to the oldest, simplest, most effective reset mechanism ever invented, devaluation masked as revaluation. This is where the pattern snaps into full view. Because the people in charge never say, we printed too much, we spent too much, we inflated away your savings, we destroyed the purchasing power of the currency. Oh, they say something much more elegant, much more patriotic, much more marketable. We're strengthening the currency with gold, and the public cheers. But behind the curtain, something entirely different happens. When a government revalues gold, they aren't strengthening the currency. They're destroying it quietly, methodically, and mathematically. They're shrinking the real value of their debt while shrinking the real value of your dollars at the exact same time. And the beauty of the strategy, from their perspective, is that the public can't easily understand it. It's not a tax. It's not a cut. It's not a vote. It's an accounting change. A number on a balance sheet. A pen stroke. A new official price. And just like that, trillions in real value disappear from savers and reappear as relief on the government's books. That's the cycle. That's the pattern. That's the playbook. Silent accumulation, parallel systems, reserve weakening, gold revaluation, debt erasure, wealth transfer. This is not new. It's not radical. It's not theoretical. It's historical. And when every major central bank on earth begins accelerating into the first three stages at once, accumulation, alternatives, de-dollarization, you can be certain the final stages are already being planned. Because the people who run monetary systems don't wait for crises. They position before crises. Crises only appear sudden to the public. To the people running the show, they are scheduled events. The next part will show you exactly how this pattern played out in the past, how Roosevelt used it to reset a collapsing America in 1933, how the 1970s used it to extinguish the last remnants of the gold standard, and why the numbers today suggest the playbook is being dusted off for another round. To understand what's happening today, you have to go back to the last time America reached a breaking point, when its debts were unpayable, its currency was collapsing, and the system itself was on life support. Because the U.S. has already executed this playbook once, and it works so well that most citizens never realized they were the ones who paid for the rescue. It was 1933. The Great Depression had hollowed out the country. Banks were failing by the thousands. Unemployment hovered near 25%. Deflation, falling prices, was destroying businesses faster than any recession before or since. And the government's debt was spiraling in real terms because every dollar they owed became more expensive as deflation deepened. America was stuck in a monetary trap. Then Franklin Roosevelt took office, looked at the numbers, and realized something brutal. The country couldn't grow its way out. It couldn't tax its way out. And it couldn't borrow its way out. Sound familiar? So he did something radical, something controversial, something brilliant from the government's perspective, and devastating from the public's. He changed the rules of the game. First, he made it illegal for Americans to own gold. Not jewelry, not coins, not bars tucked away for savings. You had to turn it in. The government paid you $20.67 per ounce, the same fixed price gold had held since 1879. Millions complied, not realizing they were surrendering the one asset that protected them from what was coming next. Because once the government had the gold, Roosevelt revealed the real plan. He revalued gold to $35 per ounce, overnight, without a vote, without a public debate, without warning. The value of America's gold reserves jumped by almost 70%. That single change created billions of dollars in new assets for the government. It shrank the real value of America's debt, and it triggered inflation, lifting prices, wages, and nominal economic activity like a lever pulled inside the Treasury. To the public, it looked like a recovery, but underneath, it was a stealth devaluation, a transfer of purchasing power from citizens to the government, hidden behind the language of stability and reform. And here's the painful truth. The people who turned in their gold at 20 watched the government reprice it to 35 a few months later. They lost nearly half their purchasing power overnight, and they couldn't buy it back, even if they wanted to. Gold ownership remained illegal for 41 years. That is what a reset looks like. Not chaos, not riots, not headlines screaming collapse, just a quiet rule change and a new official number, with consequences that echo through generations. But 1933 wasn't the only time America rewrote the rules. Fast forward to 1971. The world was demanding gold for dollars faster than the U.S. could supply it. Foreign governments saw what was happening behind the scenes. They saw the spending, the deficits, the war costs. They saw too many dollars chasing too little gold. So they began redeeming those dollars while they still could. Gold flowed out of Fort Knox. Confidence drained from the system. The math was becoming impossible. And then, just like Roosevelt, Richard Nixon changed the rules. With one television broadcast, he ended the dollar's convertibility to gold altogether. He severed the last link between the dollar and anything real. And once again, Americans woke up to a new financial reality. The dollar was now backed by nothing but trust, and the government's ability to force demand for it. From 1971 to 1980, the consequences hit with full force. Inflation soared. The cost of living exploded. Interest rates hit levels modern Americans can barely imagine. And gold, freed from artificial suppression, went from $35 to $850. A 24-fold increase. If you held dollars, you were destroyed. If you held bonds, you were gutted. If you held savings and cash, you lost almost everything in real terms. But if you held gold, you didn't just survive. You made the kind of gains central banks quietly rely on when resets happen. This is the historical pattern. When debts get too big, gold gets revalued. When currencies weaken, governments change the rules. When trust breaks, systems reset. And every time, the public suffers first. The elites reposition early, and central banks walk away stronger. That brings us to the present. Because the numbers today make 1933 look mild, and make the 1970s look like a warm-up act. In 1933, America's debt-to-GDP ratio was around 40%. Today, it's 132%. In 1971, inflation was rising fast, but debts were relatively manageable. Today, inflation is sticky, deficits are permanent, and the only way out is the same playbook used by every empire before collapse. Gold revaluation, currency devaluation, debt erasure. The US doesn't need your gold this time. It needs your purchasing power. And the fastest way to take it is to inflate it away through a revaluation no one sees coming until it's already done. This is why central banks are buying gold like the clock is running out. Because they know the past wasn't an accident. It was a template, and they know the next chapter is already being drafted. The next part will bring that template into the present, showing you exactly how today's BRICS expansions, dollar weaponization, and 2025 to 2028 timeline map perfectly onto the final phases of every historical reset. If you take everything we've just walked through, the 1933 reset, the 1971 decoupling, the 1970s inflation spiral, and place it next to the world of 2024 to 2025, the similarities are no longer coincidences. They're signals. They're warnings. They're the outlines of a story that is already unfolding, piece by piece, in real time. Because the modern world has entered the same pressure chamber, only with bigger numbers, more fragile alliances, and a global financial system that can fracture faster than any era in human history. And it begins with an event that most Americans barely noticed. The day the United States froze $300 billion of Russia's dollar assets. To Washington, it was a geopolitical move. To the rest of the world, it was something far more chilling. A revelation. A message written in capital letters. Your reserves are not yours if they're in our system. That single decision detonated a chain reaction across dozens of capitals. Diplomats whispered. Central bankers recalculated. Finance ministers met behind closed doors, staring at charts that suddenly felt like threats. China asked, what happens to our $1 trillion in treasuries if tensions over Taiwan escalate? Saudi Arabia asked, what happens to our reserves if we decide the petrodollar no longer serves us? India, Brazil, South Africa, Turkey, Indonesia. They all asked the same question in their own way. What protects us if the system turns on us? And when a nation asks that question, the answer has never changed. You move out of the system you do not control, and you move into the one asset no empire can freeze, seize, sanction, or weaponize: gold. That was the true beginning of the modern reset. Not the inflation spike, not the rate hikes, not the deficits, but the moment global trust in the dollar cracked like old glass. And when trust breaks, the search for alternatives accelerates. Which is exactly what BRICS has become. Not a club, not a trade bloc, not a casual coalition, but an escape hatch, a parallel financial architecture designed to operate outside the U.S. monetary empire. And in August 2023, that architecture took its first major step forward when BRICS expanded. 6 new nations joined the table. Others lined up immediately, not because they hated the dollar, but because they feared what staying dependent on it now meant. Together, these nations represent over 40% of the world's population, a quarter of global GDP, and a growing share of global commodities. But their real power isn't demographic, it's strategic. China produces the world's goods. Russia supplies the world's energy. India anchors the world's labor force. Brazil feeds the world's agricultural chains. Saudi Arabia fuels the world's transportation system. And all of them have begun preparing to trade with each other without the U.S. dollar. Not suddenly, not eventually, but now. China and Russia already settle energy in yuan. India pays for Russian oil in rupees. Brazil and China trade in yuan and reals. ASEAN is developing a payment system that bypasses SWIFT entirely. Saudi Arabia has openly entertained accepting non-dollar currencies for oil, and every one of those transactions pushes the dollar one step closer to something Americans can barely imagine, a world where the dollar is optional, because when the world's largest commodity exporters stop using the dollar, the world's importers eventually follow. When importers stop, banks stop. When banks stop, reserves shift. When reserves shift, currencies fall. And when currencies fall, governments panic. This is how reserve currencies die, not in explosions, but in substitutions. Not in rebellion, but in alternatives. And the most important piece of this new architecture is the one the mainstream press keeps pretending is fiction. The BRICS gold-backed trade currency. It's not rumor. It's not conspiracy. It's not a fringe idea. It's an active project announced publicly, debated openly, and built deliberately. The framework is simple. Each member contributes gold to a collective reserve. The currency used for trade between BRICS nations is backed by that gold. Not redeemable for gold, but anchored by it, a credibility layer the dollar lost decades ago. And here's the part that changes everything. If a gold-backed trade currency is launched, even in partial form, and even if it only handles 20-30 of global trade, it doesn't need to replace the dollar. It only needs to compete with it. Because when competition enters a monopoly system, the monopoly collapses faster than anyone expects. The petrodollar, America's golden shield since 1974, begins to erode. Demand for dollars shrinks. Foreign holders start selling. Treasury markets weaken. Yields spike. Inflation rises. Confidence falls. And when confidence falls in a reserve currency, history says the next phase hits with brutal speed. Which is why central banks aren't just buying gold. They're repositioning entire national balance sheets away from the dollar and into hard assets. China has accumulated between 1,000 and 2,000 tons of hidden gold. Russia holds over 2,300 tons and is still adding. India adds every quarter. Poland has nearly doubled its reserves. Turkey buys aggressively during every currency scare. Singapore accumulates in silence. This isn't diversification. This is preparation. Because they know what the final stage looks like. They know that when a reserve currency begins losing global demand, the issuing country is forced into the same endgame every empire before it used. Revaluation, inflation, debt erasure, wealth transfer. And the United States is walking directly toward that moment. Not because politicians want it. Not because the public voted for it, but because the mathematics of debt leaves no alternative. When a nation owes $37 trillion, with interest payments larger than its military budget, with deficits that grow even during economic expansions, and with foreign buyers stepping back from its bonds, there is only one way out that doesn't trigger immediate collapse. You devalue the currency quietly. While pretending to strengthen it publicly, you revalue gold to make your reserves appear stronger. You sell it as sound money, and the public doesn't realize they've just lost 80-90 of their purchasing power until it's too late to protect themselves. The same playbook applied in 1933, in the 1970s, in Europe, in Asia, across empires from Rome to Britain. And now every indicator from 2024 to 2027 points toward the U.S. preparing its own version. First the accumulation phase, what we are living through now. Then the alternatives phase, what BRICS has already initiated. Then the crisis phase triggered by falling dollar demand and rising yields. Then the revaluation phase, sold as stability, executed as devaluation. Then the wealth transfer, where those with dollars lose and those with gold survive. This isn't prophecy, it's precedent. And the most chilling part, central banks are positioning as if the window is closing. The next section will show you exactly what this means for your savings, your retirement, your portfolio, and why the next 18 to 36 months will determine whether you come out of the reset intact or wiped out like every middle class trapped in every currency collapse before this one. You've now seen the pattern, not the headlines, not the political noise, not the temporary distractions that fill news cycles, but the underlying architecture, the blueprint every collapsing monetary system has followed for more than 2,000 years. And once you see that blueprint, it becomes impossible to unsee what comes next. Every sign points in the same direction. The global financial system is turning. The dollar is weakening. The alternatives are strengthening. And the people with the clearest intelligence, central banks, are positioning for a world that will not look like the one Americans have known for the last 50 years. So what does that mean for you? It means your future depends on one brutal truth. In every monetary reset, the middle class pays the price. Not because they did anything wrong, not because they made bad decisions, but because they were the last to know a reset was coming. They held the currency, they held the bonds, they held the retirement accounts, they held the assets that look safe on paper right until the paper itself loses value. And this time will be no different, unless you act before the reset begins. Because here is what a gold revaluation actually means for an ordinary American. Your savings lose 80-90 of real purchasing power. Your bonds become nearly worthless. Your cash stops functioning as a store of value. Your retirement shrinks even if the balance goes up. Your wages lag far behind real inflation. Your cost of living jumps like the ground falling away beneath you. But here's what it means for someone who prepared. The gold they bought at 2,500 suddenly becomes worth 15,020 ounce. Their purchasing power increases while everyone else's collapses. They survive the reset instead of being swallowed by it. They walk into the next decade with capital, the thing every crisis steals from the unprepared and hands to the insulated. This is why central banks are buying gold. Not for yield, not for fashion, not for speculation, but because gold is the only asset that survives the end of a currency's life cycle. No counterparty, no default risk, no freeze risk, no sanction risk, no political risk. Gold is what nations buy when they no longer trust the system. And 3,000 tons in 36 months tells you everything you need to know about how much trust remains. So here is the personal playbook, simple, clear, and brutally practical. Start with your liquid net worth. 10 to 20% goes into gold. Not your house, not your car, not your fixed expenses, your investable capital. 70% of that allocation goes into physical metal. Coins, bars, bullion from reputable refiners. Something you can hold, something no bank or government can turn off with a keystroke. 20% goes into ETFs, your liquidity layer, your retirement account layer, the piece you can rebalance when markets move fast. 10% goes into mining stocks, your leverage layer, the high risk, high reward segment that multiplies when gold begins its march upward. This is not financial advice in the traditional sense. This is survival positioning. The same positioning central banks have executed at national scale. Because once the revaluation hits, timing no longer matters. The window closes, and everything after that becomes reaction, usually too late. Now, let's address the objections. because every reset forces the same questions. What if the government bans gold again? Unlikely. The dollar is no longer backed by gold. The government doesn't need your coins. Confiscation won't fix $37 trillion in debt. Revaluation of existing reserves will. What if gold doesn't move for years? Then you've held insurance. Insurance that costs nothing but temporary opportunity and protects everything when the system breaks. Why not just Bitcoin? Because Bitcoin is innovative but untested in a global monetary collapse. Gold has survived every collapse since humans began minting money. Bitcoin may be the future, but gold is the bridge to that future. And right now, it's the bridge central banks are standing on. The next 18 to 36 months will decide everything. Not because the world ends, but because the monetary rules that shaped your lifetime may not survive past 2027. You don't get to vote on this reset. You don't get to stop it. You don't get to delay it. But you do get to prepare for it. You can stay where most Americans stay, fully exposed to a currency that will be quietly hollowed out to save a bankrupt government. Or you can step off the tracks. Follow the signals central banks are broadcasting at historic volume. Protect your purchasing power before the reset begins. And position yourself on the side of history that survives the collapse instead of being crushed by it. Central banks have made their decision. 3,000 tons in 3 years. The fastest accumulation since 1950. The kind of move institutions make only when the end of a monetary era is near. Now, you face the same choice, only on a personal scale. That determines the life you will live on the other side of the reset. Prepare now, not later, because once the revaluation happens, once the dollar breaks, once the new system is announced, there is no undoing it. There is only before and after will belong to those who saw the pattern early and acted.